bring in Hammoury now, who's Chief Market Strategist at Equiti Group. Good to see you, Nour. Now, global equities posted strong gains despite geopolitical tensions. What factors outweighed investor concerns?
Good morning, and thank you for having me. Markets are telling us basically something very important. Investors are not ignoring geopolitical risk, but they're also ranking it below earnings liquidity and also the AI-driven growth. Key support came in from three areas. First, corporate earnings that are still holding up. Second, we have oil fell sharply from the panic highs, and this basically reducing the inflation shock. And third, investors are still willing to pay for technology and AI-related growth. So the resilience here is also not because risks have disappeared. It is because markets believe the shock is contained, and as long as oil does not spike again, equities can continue to climb the wall of worry. And from my perspective, at least, the deeper I get into AI developments on a daily basis, the more convinced I become that the market is still underestimating how powerful this technology really is. Maybe most people see AI as a tool to make exciting, or existing tasks faster, but that's only maybe the first phase. We're rapidly moving towards an AI systems that can automate entire workflows, generate content, conduct research, write softwares, analyze markets, and eventually collaborate with humans as specialized digital workers.
Gold, on the other hand, has clocked its worst quarter in 13 years. And given its traditional role as a safe haven asset, why has it fallen so sharply despite heightened geopolitical uncertainty? And do you see this as the beginning of a broader downward trend?
Gold decline might look strange at the beginning or at first because geopolitical risk remains high, but the real pressure came in also from interest rates and the dollar. Gold does not pay basically yield. So when markets price in more hawkish Fed and a stronger dollar because of the potential rate hike, the opportunity cost of holding gold rises sharply. And that is why gold can fall even during geopolitical stress. I would not still call this as the start of a structural bear market yet, at least. It is more of a reset, if you might say, after a very crowded rally. And the key level is the psychological one. And if gold keeps holding around that 4,000, the long-term story remains alive. But if the Federal Reserve also sounds even more hawkish, I think the correction will continue, and we might actually even reach 3,800.
And oil prices are stabilizing as investors weigh the possibility of a permanent end to the US-Iran war. Do you see further volatility ahead?
Further volatility, as long as there's no further, at least escalation or the continues of the Iran or the US-Iran talks. I think this is very important. The risk is not just basically whether if it's going to be an escalation or not. As long as the diplomacy is there, I think the volatility will still be contained. And at the end of the day, I think the markets also still likes volatility, but it depends on what kind of volatility that we will be seeing. But the momentum can continue into the second half, and it still needs a little bit of some conditions, especially that oil must remain contained. Earnings also must keep improving, and the Fed must avoid surprising markets with aggressive hikes.
We will leave it there for now. Nour Hammoury in Dubai, thank you very much for speaking to us.